Yo, what's up, Outliers? Happy Friday. I hope everybody had a killer, swell, wonderful week. And we are at the week's end. And believe it or not, the actual end of the month is coming up, leading up to the last trading month of the year. This is a really interesting time from a statistical perspective. And the reason for that is because there's only been a handful. Whoa. Look, I'm trying to find the post on X, and there's a hell of a headline against McGregor. But that aside, there was a really great post on X about where we're at in the market right now. And I'm trying to give credit where credit's due, but I can't find it. I don't know where it is. Anyways, it was somebody that just I tend to follow because they post just very standard statistical takes on the market. And there's been a series of times where the market has had back-to-back 20+% returns on the year. And it's infrequent. It's like, I want to say it happens like maybe 6 times or something like that. And each time after those 6, there's been a pretty meaningful series of drawdowns the following year. Those kinds of studies are always interesting to me because they seem to, maybe identify a little bit of a trend, but you can't really take it as a trend like that. The market doesn't have a memory to that degree like other kind of statistical functions that we might look at. So I like stuff like that. It's pretty interesting, but there's a bit of a drawback to it, I think. So yeah, overall interesting. I'll see if I can find it and post it for you guys. So a couple rules of the road for today. So I decided to go back to the options trading basics on Fridays, and it's because I want the next handful of Fridays that we have left in the year to serve as a primer for the beginning of next year. And the beginning of next year, probably like mid-January, because we do a bunch of traveling the end of December into January typically. But sometime in 2025, towards the beginning, I'm going to kick off the Outlier Options Trading Bootcamp series again. Now, this will probably be something a lot of you will want to pass on because it's going to start from ground zero, the very beginning again. So we're going to go through what the market does, what derivatives are, all that kind of stuff. So for a lot of you, it will be repeat, three-peat, tri-peat information. But I like to offer, I'm going to try to offer 1 or 2 of those per year for those that are just brand new to options and to try to continue offering a healthier on-ramp. Because the more I poke around different kinds of places, the more I realize that that kind of thing I actually think is needed. Because it's easy to judge what other people do and to have preferences, but it is kind of interesting to me how difficult I can tell it is for people that are trying to teach other people stuff to just remain objective to information and to not let preferences bleed through too much, which can taint other people's perspectives, right? A great example of that is if you look at the Theta Gang community. The Theta Gang community they genuinely believe that selling is better than buying. Like they genuinely believe that. And there are absolutely use cases, and there's no debate that selling can work, but it doesn't make it better than buying. There's plenty of people that buy options that will crush what Theta Gangers earn in a year. And that's not to besmirch Theta Gangers or to say options buying is better. It's just an objective reality that when people get too wrapped up in their preference, they forget the ability to remain objective when they're talking about stuff. And the reason why I cherish objectivity so much in trading is because it is a really, really important element to be able to look at and evaluate opportunities, but more importantly, from a perspective of trying to help people learn about options and trading, it's really detrimental if you impart too many of your own biases onto them. And it's because I, Eric, have my own series of biases that stem from all different kinds of things, right? It exists, it's there, I know it's there. Now, the tricky part is my biases are not going to be the same as yours. The way that I view the world is not going to be the same as you. And a big part of creating a successful approach to trading is reconciling an approach that works well for who you are as a human being and creating harmony between what you're doing and who you are. That sounds a little esoteric, and I can give you an example. Let's say that you are a overanalyzer. That's one of your traits. You like to look at things in depth. You tend to look at them again, check what you looked at, and it's this continual process. There's strengths associated with that. So by being that kind of person, it means you're highly analytical. You're going to find a lot of good information. It also means it's really difficult for you to make a fucking decision and put on a damn trade. Somebody like me is different. I'm more impulsive by nature, and that's a lot of what I've been brought up on in the military. We're very oriented on an 80% solution right now executed violently is better than a 100% solution later, right? So to try and create a harmony between your approach is super important so that you're not creating additional friction in the deployment of a strategy. And so many people skip over that, right? So many people jump straight into how they think they want to trade, what option strategy might be better. And none of that really fucking matters until you have a decent understanding. And to be clear, it takes a little time to figure out like who you are and what your tendencies are as a trader. It's not like going to be super apparent in the beginning. It's funny because looking back at it, it is like, I look back and it's like, how the fuck could I not have seen that? It's in HD when I look back at a lot of my tendencies and traits. It's in bold letters with neon signs. But in the beginning, it's difficult because you don't look at things that way. So it'll take a little time to piece that together. So there's a couple things that I wanted to start with. One of them was a couple quiz questions. And I turned to Perplexity to help with the quiz questions. And the first series of quiz questions it gave me were straight trash. They were, I wouldn't even call them way too easy. They were like offensively easy. But we'll start with one of them just so that everybody can feel a little bit better about themselves. So the first question is a multiple choice question. I'm actually going to throw it into the chat. Let me see. And it can take it all. That's great. So there's the first question. And let me grab the chat so I can say hello to everybody and we can answer this question together. So you could just throw in A, B, C, or D. I'm not even going to really bother evaluating the answers because the question is so stupid that it's a general waste of time. But I wanted you guys to at least get a sense of the kind of bullshit that Perplexity tries to feed me to ask you, which is just madness. I'm not about this. So then I said, literally, this is what I told Perplexity. I said, make these questions much, much more challenging. Much, much more challenging. And then what Perplexity came back with also pissed me off. So here's the next question. It said, after I told it to make it much, much more challenging, this is the next question it gave me. I just threw it in the chat. You can throw your answer to that as well. And it says, which of the following option strategies is not a defined risk strategy? That's what it's asking. So this reminded me as I was reading these, I was sitting there thinking, this is a good time to talk about benchmarking and what the outlier mindset is about and what our benchmarks are. Because you could tell for, again, Perplexity or something else, it's creating questions based on the average person. And these questions that you see here are, even when I said make it much, much more challenging, it gives me another joke of a question. So when we're going through our trading career and thinking about what we aspire to, this is why I genuinely believe the only worthwhile benchmark for what you try to emulate and what you try to be is a better version of yourself. If there's ever a point in your trading career, or really in life, this is sometimes, my wife will do this sometimes and it drives me fucking crazy because she'll say like, oh, it's much better than blank, or I'm not as bad as blank. And, or, you know, whatever it is about blank, right? As like the benchmark comparison. And I always remind her, and I always remind you guys, I couldn't literally possibly care less what the average benchmark is. I couldn't care less. It makes no difference to me. That's not the field I'm playing in. That's not the field we operate in our community. It is completely superfluous beyond having it as a benchmark, because you do need to understand what average is. That's just a general understanding of the landscape. But when we're creating benchmarks in terms of performance aspirations, that ain't it. That is not it. Because when we go through something like a trading career, we've already talked about this. In order to be successful, you already know you have to functionally be an outlier. You have to be a statistical anomaly in order to be successful in trading long term. It is quite literally a requirement. Now, again, we've done this similar study before where if you think about the average trader and what the average person's path looks like, it's no wonder why the failure rate for trading is so astronomically high, right? Think of what the average person does when they try to start trading. They think that they're going to make a bunch of money super fast without risk. They're going to turn their $500 into a few $1 million, cheap, easy, all those other buzzwords. And no shit that most of them fail, right? Like, that's not the cohort that I'm going to benchmark myself against, because again, if I'm doing something like climbing, let's say going to Tanzania to go climb some of the mountains there, because that's what a lot of people do beyond the safaris. And if you go up Mount Kilimanjaro, your comparison for Mount Kilimanjaro success rate isn't like the gross number of people who ever think about climbing Mount Kilimanjaro. It's the people that actually trained, prepared, attempted, and did or did not summit. So when you decide to be a trader, you have to change your reference benchmark immediately. What average is and does only concerns you from the context of understanding the landscape. At no point can you ever say, oh, most people mess this up, and then use that as a data point to make yourself feel better about whatever it is you're trying to make yourself feel better about. You are going to have to be your own biggest critic, but it has to be healthy criticism. Anybody that's in the Discord and has interacted with me there, you all know that I'm direct and I'm not pussyfooting with anybody in there. And at no point is it to disrespect people. It's literally the last thing I care to do. But it's because in order to make some sort of meaningful growth and progression in your life, if you cannot take criticism, harsh, direct, robust criticism, onboard it, and then turn it into something to develop and optimize your approach further, this shit ain't going to work for you. Because the other thing I can tell you on this same thought process, going back to what I was just saying, you having to be your own biggest critic, the stuff that I talk to you all about is in passing, typically a couple sentences about a specific topic, right? Like, I'm only interacting with you and your perspective for a few moments in passing. You live with you. You are the one that has to analyze what you do so that you can try to create some level of success. The last thing I'll say on this same vein is that It is up to the person to determine the way that you move through markets. What I can tell you unequivocally is that markets are going to find every single one of your fucking weaknesses. Every single one of them. They're going to be there. If you're impulsive, if you suffer from analysis paralysis, if you're not thorough, if you're lazy, if you change your mind too frequently, if you're not consistent, if you're not thorough in historic research, if you're not methodical in planning, it will literally highlight every single issue you have. It's up to you as the trader to have your fucking eyes open, your ears open, and to pay attention to what the market is telling you about you. It's going to tell you. But most people are too concerned about protecting the ego because the ego doesn't like being challenged. The ego gets uncomfortable if it's confronted, if somebody or something tells you you're wrong. This is a reason why most people don't like having trade logs, is because it forces them to confront the reality of their strategy and their positions. People hate that, and it's why they don't do it. It's literally why they don't do it. But if the goal is to try and do this and make meaningful amounts of money, it's what needs to be done. I made a post in the Discord earlier today, and I go out of my way to make posts like this mostly because I think people need to keep stuff in perspective. And I think people need to understand the potential power that can come from this stuff. So this is a post I put earlier. Long story short, Cliff Notes version for this post. I was talking to my mom on the phone earlier. She said that she was waking up kind of achy. And then, I was asking her about the conditions around that. And she said, oh, well, I think my bed has like a divot in it, right? So the fucking mattress is old. While I was on the phone with her, I was just like, oh, we need to fix this. And I essentially go out and I find a, oh, thank you, Mr. Igor. Great heads up. I find a mattress that I could get to her that I like, because we use the Sattva mattress. We have a different one than this, but the main point is that through trading and through investing, I've gotten to a point where I can essentially identify something I care about, spend very little time. Like, this purchase was made in 30 seconds from the time of her telling me, because I knew the exact kind of mattress that I think would be good, talked to her a couple seconds about it, and launched the order, right? Done and done. So trading is fantastic. Trading enables really cool things, but it only gets to that point unless you allow yourself to go through the process, which is going to include being wrong all the time. And it's going to be a continual process of making really, really thorough, tough analysis of yourself and making yourself better. So that's my overall spiel on trading, on why I think it's genuinely worth just about everybody's time. And I think if people approach it with the right mindset, it's entirely doable. It really is entirely doable. I think I generally embody some elements of that, right? Because I am not a genius. I genuinely am not. Like, I am a fucking hyper normal person. But what I've done is figure out a way to lean into some of my strengths, to try to bolster some of my weaknesses, to create an interaction with markets that works. And what that looks like for other people will be different. And this is a big thing that I spend working on in the mentoring program that I have through Patreon, is trying to help and that's why I do it in that setting, is because it takes a lot of time for an individual person to analyze themselves thoroughly and identify what kind of approach best fits them to interact with the market. It takes time to get to that level of understanding. It's not easy to piece together, I think, for a lot of people. So it's doable. It's not easy. It's simple, which is the beautiful part, but simple doesn't mean easy. So that Lauren says, being wrong all the time makes it super exciting when I'm right. See, but that's also a problem, Lauren. You already know. Lauren, damn it, Lauren. You're the first fucking name I see in the chat. And then I already got to start tearing into some shit. Sorry, Lauren. The problem, what you guys tell me, what's the problem? What issue do I have with what Lauren just said? You guys already know. You guys already know that I have a problem with that, probably. So what do you think my ish is? No feelings at all, Lauren. That's not it either. Reese is not correct. Tommy says exciting is the issue. That's correct. That's exactly correct. Lauren says, that's okay. I'll cry to my long legs. Well, I think by the time your tears finish flowing, they would probably evaporate after, expanding the surface area of your legs. But Reese says hyperbole. Hyperbole is fine, but again, like people think that. People genuinely think that the target is to have no feelings, and it's not accurate. It's genuinely not accurate. So the reason is because it's completely unobtainable. But what Tommy said is exactly correct. Exciting. So Lauren, from your perspective, why do you think that I take issue with the concept of exciting? Why do you think that I specifically call that out for you? Exciting. There's two reasons. And you already know. All right, thank God. My watch is finished charging. So I use my Garmin Dive watch as like my daily watch just because I don't like changing it. And part of my OCD is making sure that it's charged, obviously. But then it feels super weird when it's not on my wrist. That Lauren says exciting is not calculated. That's one of the issues. There's two main things that I want to talk about with this concept of excitement. Let me see if I can get my little marker up here. Okay, so trader. I guess there's 2 R's in trader. Trader feelings. Excitement. So in this context, something like excitement means happy, affirmed. I don't know what else you would, joyous maybe. It's just kind of a synonym for happy. But really the thing I'm trying to highlight is that there's obviously a feeling of elation to a degree, and then there's a feeling of affirmation here. So these feelings, exactly as you guys point out to the first component, which Lauren highlights, is excited alters decision making. That's problem one. There's actually a second and a bigger problem here. So this is the first problem. What's the second problem that you think I have here? There you go. Lauren is actually talking about it right now, if you guys can see. Reese says if we're too excited, we'll be too disheartened if it doesn't go our way, right? So then we'll obviously go through the ebb and flow. We'll have the general ebb and flow of emotions, which I normally draw as this. And what I try to describe to you guys is like the outlier emotional cycle, as I call it, should be more like this. And well, let's just call this like the midline. Sorry. Something like that. So this is obviously happy. This is sad. So this is the standard cycle for a lot of people. And my argument for outlier trading is it should look like this. So the idea is we're dampening our emotional response. For those that don't know, when you have an emotional response to something, and it's a response, just get rid of the word emotional. When you respond to something, there are a series of biological and physiological effects that occur. Some of them are mental, some of them literally are chemical, right? So think of it if you consider when you get excited. Typically, your heart rate will pick up a little bit. Typically, your attention will pick up a little bit. Typically, your eyes will open up a little bit more, right? You're trying to take in more information, more of the stimulus. I'm just highlighting some of the physical responses. The issue with this is these two go together, happiness and sadness. If you experience big happiness, you're going to experience big sadness. That doesn't mean that you can experience, you shouldn't experience happiness. You obviously should, but it should be tempered. Now, this second part is even more important than this first part, in my opinion. Part do. What is it? Do. I think that's like French, right? Is that French? Part do. I don't know how to say that. Do. I'm going French. So, Lauren, based on your last comment, what's the second thing that I'm highlighting here? So I gave you the first error with excitement. The first error with excitement is that it alters your decision making, and then you're going to send yourself down the emotional path. One, do, Troy. But how do you say do? Is it do? Need to know how to say that. Do? Somebody phonetic it out for me. You guys know I do well with phonetic spellings. That's one of, I actually realized that it's deaf. Not deaf. Is it not deaf? Do? Oh, do might be it. I thought it was do. Yeah, okay, so I think you guys got it. I gotta pop the door for Thor. Okay. Duh. The U sounds like the U in push. Push. Duh. All right, I'm a Dua? There's a soft R on the... Okay, you guys are fucking me up. I thought... Hold on. You guys have me all over the place. Somebody has me putting a fucking R in there. Somebody has me saying is do. All right. D-E-U-X pronunciation. Here we go. Do. It's do. 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 There's no R. One of y'all was trying to get me to say an R. It's do. And the guy that just taught me that on YouTube was very specific that it goes like that. Okay, so then back to this part back to part do. Here's nobody's got it so far. Lizzie says there's a soft R. Not my fucking French coach, Lizzie, that I just spoke with. Hold on, I'll send you the link so you can hear him. He sounds legit. I actually didn't even pick up the YouTube channel. So I can't actually confirm that he's good. He sounded good. How to pronounce D-U-X. I'll send you the channel right now. This guy by Julian Miguel. That's like about as legit as it sounds. There you go. Well, my tutor, Julian Miguel, says it's not like that. So we'll have to continue the fight about it. Okay. Back to this. Back to part deux. What's the bigger issue here? What's the bigger issue with excitement? I want you to think about the impact that this can have, not on this instance, but on your performance and your behavior as a trader long term. There's a very specific thing I want you to identify with this and why it's problematic. Greed, that's not it. It's close. You're on the right path, but that's not it. TCM says my excitement causes me to overhold. That's not it. We'll give you a couple more guesses. See if anybody can get it. See if anybody can get the fake internet point. It's ready to go. The fake internet point is queued up, ready to be just offered to whoever crushes it. Failure? Nope, that's not it. Reese says, I missed the question. That sucks. Joe says, I get underwhelmed and cut too early. That's not it. Lance says, equal negative portfolios. That's not it. Good guesses, but that's not it. I want you to think about this. What happens in this path? If you're trading a system and then you have 2 losing trades in a row and then you have your winning trade, between this, you start off and you're like, that kind of sucks. Okay, this isn't going super great. I hope the next one works. Great. Yes, this one worked. This is perfect. Awesome. So now let's build this out into a longer series of trades. The reason why excitement becomes a problem, TCM King is very close. The reason why excitement is the problem is because it's literally it's a misaligned trade expectation. We're focusing on the wrong thing. What I mean by this is whether or not you have a trade that's a winning position or a losing position genuinely should not move you much one way or the other. Genuinely, it should not move you much. The reason why it should not move you much is because when we're trading in the service of a system that's designed to be moved over the long run. So the reason why excitement is a problem is because it creates a vicious cycle in terms of literally decision-altering biochemical responses. But the bigger problem is that it creates misaligned incentives. You start pursuing the sensation of excitement when you're right. There's nothing wrong with wanting to be right. There are some traders who are drastically motivated by that. The problem, though, is that it's emphasizing the wrong aspect of a successful trade, right? So for me, I would consider a successful trade to be something where I'm executing a defined and researched strategy that I know is positively expectant in the long run. That's what I care about. So if that includes taking losing trades in pursuit of the winning trades, that's okay. It obviously needs to make money to make sense. But the main thing is to not have misaligned incentives for your trades. The incentive for the trade should be the deployment of a positively expectant strategy. It shouldn't be for entertainment, for excitement, for thrills. You can have, to be clear, really small elements of your portfolio that you like to do that with, as long as you can mentally partition them, right? Because let's say, for example, that you like to gamble, you like to wager money to try to make money. That's okay. There's nothing inherently wrong with that. It's wrong when it goes out of control. And the other thing I can say is I would rather somebody that gets their kicks off of an individual trade than going and buying a scratch off from the lottery, right? Like the better risk proposition probably with respect to trading. But in trading, if we overemphasize the feeling we get on a winning trade, it starts to skew everything that we do, and it literally is a misaligned incentive. Black Mama says, hit home runs and cut losers small. Maybe. Again, we can't make sweeping statements like that. The reason why you can't make a sweeping statement like that is because it depends entirely on the system. You don't have to cut losers small. You don't. It depends entirely on the system. So the important way to think about it is that there isn't a one-size-fits-all rule that will holistically cover all of this stuff in terms of what you should do in managing your risk. It doesn't exist because the conditions are going to be unique based on what you're doing. So the lesson there is that we actually can't say something like, let winners run and cut losers short. It makes sense. Definitely can hold water, but it's still going to broadly depend on the strategy that we're running. You can have strategies that have big losers, but very few of them. That can still be positively expectant, and there's nothing wrong with it. The message there is to do something that makes sense relative to whatever the strategy is that you're trying to run. That's the idea. So, Joe says, of course, who doesn't love being right? And that's another just common problem that traders face, is that sensation is really difficult for people to manage, right? It's ego driven. That's the whole idea of being right, is ego driven. Once you learn how to sequester your ego and you value pursuing something else, for me, I prefer to value the pursuit of what I would consider to be correct, objectively correct information. So that's stuff that can be quantified, it can be qualified, it's something that's definable. And a lot of times when I notice I'll debate with people on Reddit or, in the Discord, and I say debate in a healthy sense. They're healthy arguments. Argument is another one of those words that most people think it means a bad thing, but it doesn't. Like, an argument is just the exchange of ideas that are typically opposing. It's just when people have bad arguments, they tend to revert to things like ad hominem attacks and, stuff like that. But healthy arguments, sometimes people, they get too wrapped up in trying to defend a point, and you can always tell that perspective because they will spend more time trying to prove theirs as compared to understand the other sides and then to explore truth together. So it's a really, really, really delicate balance it's built over time, without a doubt. So let's take a look at the focus topic for today. And this one is from Tommy. And Tommy asked when to buy options versus sell options for directional trades. This is a great question. It's also, fortunately, very easy to answer. So we should be able to move through this one pretty quickly, hopefully in detail, though. Obviously, as you guys know, I have a penchant for detail. I think that's where a lot of the important information lies. So let's talk about this. First things first. How do we even approach this? So if I weren't here to kind of walk you through via a framework, how would you in the chat answer this question? And I would love to see some of the responses. The reason why is because one of my approaches to doing things as a trader, and again, most people that interact with me have probably learned that I use decisions that naturally narrow me down to a choice. I don't just try to make the choice. And I'll explain what that means in a moment. But for you in the chat, how would you respond to Tommy here? TCM King says, do both at the same time. You could. I don't think that's what I would do, but yeah, you definitely could do that. What else do you think? There's a couple really important elements to this that we have to dissect and understand together to get to the right answer. Because here's I forgot, we can just draw on here. This is great. Let me grab my notepad. Lizzie says depends on your trading objective. Here we go. This is the correct path. Tommy says portfolio needs positive or negative deltas. If long isn't positively expected, look to sell options if risk reward is within tolerance. That's not quite, actually, because you can get positive or negative deltas by buying or selling, right? It depends on what you buy or sell. If you buy a call or sell a put, you're getting the same positive deltas, slightly different behavior around them, but you're still getting positive deltas. So starting with the portfolio need is definitely a big part of it. So here's the process that I would follow. 1, portfolio need. What does this mean? This means I'm going to look at overall deltas, that are beta weighted. I'm going to look at gamma. I'm going to look at theta. I'll start here. So then let's say that we get through the portfolio level analysis and there's no need. We don't need anything. Now, I'll give you a quick scenario based on something like theta. Let's say that we analyze the market, whatever, and we're looking through our portfolio and we find that we're short theta. Depending on what you think about the market, how you manage your portfolio, for me, I don't like being short theta. So here, this would tell me I need long theta. So then what does that back me into? Sell strategy. Now, whether that's done for a directional trade or a neutral trade, that's all TBD. But this is a portfolio-driven need. I'm just giving this as an example. If there's any questions on this, let me know before I move on to the next step that I would take. And you guys should know what I'm about to write in here. Okay, so there's no questions on 1. Great. Let's talk about number 2. What goes in here then? We looked at the portfolio. We're saying that we don't have a need. We need to identify if we're going to buy or sell an option. We know that we're looking for a directional trade for whatever reason. That's what we prefer for the portfolio fit. But we need to decide if we're going to buy or sell an option. What's the next primary thing that will naturally back us into an answer? We won't have to make a choice at the end of this. The choice will be made by going through this framework and just answering supporting questions that lead us to the answer. Lizzie says opportunity. That's very close. There's a specific terminology I'm looking for here. Time frame. Nope. You can buy or sell across time frames. Again, they'll have slightly different behavior. That's not it. Think of it this way. If I'm looking at a stock and I expect the stock to go like this. Think if I'm looking at another stock and I expect the stock to go like this. How would this inform my decision making? Vol? Sort of. I'm grabbing a trend is part of it. That's not it though. What's the first step here in the outlier strategy process? Profit mechanisms. Why does profit mechanism come first? Profit mechanism literally is going to back us into the answer. If we're looking at something and the profit mechanism is a breakout, strong directional move, if I'm trading something that I expect a strong directional move, MSTR, this is literally perfect. If I'm looking at MSTR and I get into MSTR here when it's 296, and I think that there's going to be a strong directional move, which scenario would I prefer? Would I prefer to sell premium and cap my profit potential, or buy premium and maintain uncapped profit potential? Which would I prefer if I'm thinking of a big move? TCM's on it. I would much rather buy options. Why wouldn't I want to buy options if I expect something to move a lot? There are other details that need to be brought into the equation. It's not as simple as I just think it's going to move a lot, so I'm going to buy options. There's a couple more decisions that have to be made. My phone is... What the fuck is that? My phone literally just started going off. I am going to close everything because it did this last night too. Interestingly enough. There was nothing open. YouTube wasn't open. It looks like there's an update, which probably needs to be done. I'm going to update this bad boy. I was like, what the fuck? Tommy says if port needs neg theta. No, remember, right? We already, in the scenario that I gave you, we're saying that there isn't a portfolio need. That's the context here. So the way that this decision is made for us is by the profit mechanism. If I think something's going to move a lot, I'm going to lean towards buying. If something is less expected to move, so maybe smaller expectation, then this can be buy or sell. And there's other things we can do to amplify the decision. But before we worry about the nuance between this scenario, there's a third point that again will naturally back us into a decision. So I already told you about the profit mechanism. Let's assume that in the profit mechanism, we're including the signals to validate the profit mechanism. So let's just assume that that's done. So how do we decide if we're going to buy or sell options? We start with a portfolio need. We then analyze what we're looking at, the profit mechanisms and signals to create alignment there. There's a third step. And again, the third step is overarching, and it's naturally going to back us into a decision. So what's the third step? What's one of the things you have to look at for every single trade before you enter? Guesses. What do we think? What's something that you have to look at? Size, very close. You are very warm. TCM, I want you to zoom that idea out a little bit. Reese and Liz, you're jumping to expected return. Not quite, but that would be after this. Exit criteria is very close. So far, TCM is the closest. What's one side of the trade that traders typically don't like to look at? Sim is going to probabilities. That's not it. It's a good guess, but that's not it. If I'm structure, that's not it. Loss. Bingo. Lizzie's got it. And since that was a generally unassisted response, Lizzie gets +1 fake internet point. There it is. Congratulations. MG Trades also got it, but MG Trades got it a little bit too late. So there's no fake internet point for you. So sorry about that. That's how life goes, though. Loss profile. This is the next step that will back us into this scenario. So, step 1, portfolio need. Step 2, profit mechanism and signal. Step 3, risk profile. So now let's put this into action. Tommy, give me a recent ticker you were looking at for a directional trade, and let's build a trade together. What you got, Tommy? Sim has the right question here. What you got? And it looks like Mel is requesting Carl Strauss for dinner, which I can accommodate. Tommy, did you fucking leave on us? This is straight bullshit. You left on us. I'm not going to forgive you. That's like unforgivable behavior. Here we go. MSTR. No, you don't have to pick the trade. That's the whole point, you freak. We're going to do it together. MSTR, that'll be it. So in this scenario, Tommy has decided that he wants to get exposure to MSTR. So let's take a look at it together. Let's move this. Now, again, in this scenario, we have no portfolio need. We're just looking to be long. Tommy, what day are you looking at MSTR? Are you wanting, like, are we talking about today we're exploring this? Or were you looking at this historically? And if so, how long ago were you looking at this? Because we can use on demand to go back in time. I want to play the scenario as you saw it. That's my intention. So are we playing it from today? Or are we playing it from a week ago, 2 weeks ago, the 21st? Got it. Let's do this then. So let's go and build trade. We have to go to the 21st. Oh, yesterday? I don't know if this will let me do yesterday. It doesn't. We can't go back, unfortunately, because it's too close in time. So let's just go off of building a trade from today that I imagine is the second best since we were looking at just yesterday. So portfolio has no need. We know that the profit mechanism is going to be movement. So Tommy, how do we qualify the profit mechanism in MSTR? Remember, the first level profit mechanism is very basic. It'll be based on price up or down, volatility up or down. There's very simple traits for profit mechanism at a base level. Then the profit mechanism type is where we get a little more specific. So, Tommy, looking at this, what's our profit mechanism? My assumption is that we're thinking price direction up. Yep. Okay. So price up. So now, Tommy, let's look at the type. There are different types of price direction up. We can have things like drift. We can have things like momentum. We can have things like breakout. You don't have to get that specific. Mostly and you don't have to pick my terminology. Describe in a word picture the price direction up as you expect to see it. Do you expect to see something that is just kind of slowly drifting up? Is it something that you're expecting to continue to see this kind of parabolic move up? Those are really the two main scenarios: off the chain and expected to moon. So we're expecting big movement. Okay. So now, based on step 2 of our scenario, I think the text is black, so it's not going to show up here. It'll be like, yeah, let me move this over. So based on step 2, we just decided that we're looking at a big move, potentially. Okay. So out of buying or selling, which would we naturally drift towards in that scenario, based specifically on the profit mechanism and the type to start? We can either buy or we could sell. Which one of those do you guys think fits better here? Buying long calls. Okay. So we're looking at buying. That's what we're leaning towards. So now we have to consider the risk profile. So let's build the trade. So we decide that we want to buy. I'm just going to default to some standard buy protocols just to move along. And let's say that we look at like this 67 delta, something like this. We were looking at a couple other scenarios, I think, yesterday. I'll delete those. So we're looking at this trade. Or let's say that we were going to sell. We follow our standard selling protocols. And we look at something like this. And now we have a comparison point. So now what we can do, take a look at the chart. And Tommy, based on your expectation, where would you deem yourself wrong to the downside? So if we're expecting price direction up, we're expecting a big move, where to the downside would you consider yourself wrong? And then I realized I got to take some ibuprofen. I'll be right back. What do we got, Tommy? No answer from Tommy? What the fuck? 362. So 362 is where we're wrong. Beautiful. So Tommy is picking here. That spot. No, that's 360. My bad. Delete. Delete, delete. Come into a 3 month. Be more accurate for you. I don't want to misrepresent your idea. There's 362. So now let's come into the Analyze tab. Let's add our incorrect where we think we're wrong, 362. 362. 2. This represents a bigger than 15% decline against us. And let's take a look at these two trades. So the long call at 362 is going to lose you $5,000. The short put at 362 is going to lose you $21.44. So now we look at step 3. So we grab this again. I just gave you 2 scenarios. I'm just going to change the color of this. So that we can keep it here. So I don't have to keep dragging that other thing over. So 1, port need. 2, profit mechanism and type and signal. 3, risk profile. So here we have 5K for the long call, risk profile at loss target to start, 5K in the long call, 2.1K on the short put. So, Tommy says, I missed how you changed toss to see the loss on the short put. Can you step through again? You just click it at the bottom. So you just right click and hit analyze trade, or you can anything like that. It'll be, it'll pop up on the risk profile. The other thing is, for those that don't have Thinkorswim, you literally don't need Thinkorswim to answer the question for you. This just makes it a little bit easier. But the other thing you can do, and this will confuse everybody, but I'm going to show you anyway for those that are able to understand it. You can look at what I do. I call the surrogate option, right? So for the surrogate option, we're saying right now, MicroStrategy is at 422 and we're wrong at 362. So it's a 60-point drop. So what we need to do is look at a 60-point change in the underlying from where it's at. And then we can look at our options, right? So we're saying that we're short the 310. So then if we move 60 points, we can simulate what our option would look like. So in this case, we get in for like 556. If we move 60 points, our option will look like these 370s. So then you can eyeball what the variance is between those premiums. And that can be another way just to speculate and eyeball what the loss could be at your point. You can also just do the math. Those are just 2 easy ways to do it. Tommy says, I only see the long call. Yeah, it's just because the screen's too big. So the screen that I have is like 49 inches. You guys can't see the full width as I have it. But I'm just literally clicking the boxes to check on check. So back to the question though. The next question here is, what do we think about both of these loss points? What do you think in a nutshell? They're very different. So from a risk management perspective for the portfolio, there might be a clear preference. Based on the size of the portfolio, let's say that we're assuming a $100,000 account. Well, if you have a $100,000 account and you consume a $5,000 loss, that's a 5% drawdown on the account. That's a problem. Tommy says long call has unlimited upside, short put doesn't. That's not what I'm talking about here. Remember, we're looking right now specifically at the loss target. Very specifically at the loss target. So what I'm saying is the whole point of analyzing the risk profile part of this trade is, again, I'm showing you that we can naturally back ourselves into a decision, right? So if we look at a scenario where we have a $100,000 account, this one is a 5% drawdown. This one is a 2.1% drawdown. From a risk management perspective, which one of these fits into the portfolio? Now, to be clear, either one of these can be completely fine, but it's based on the way that you run the portfolio. It's based on the way that you run the strategies. So again, remember going back to the point we said earlier, way towards the beginning of the stream, that you can't just arbitrarily pick something. It has to make sense based on what you're doing. So let's say, for example, our portfolio has a maximum drawdown for a directional position like this of 2%. Well, if your maximum drawdown potential in this kind of trade is 2% based on your strategy, you are naturally backed out of the long call. You don't get to pick it. It doesn't fit your risk profile. Now, let's just assume that either one of these was fine, that you don't actually care, and that you can go up to 5%, for example, which I would argue is way too large, to be clear. On a $100,000 portfolio, a $5,000 drawdown is likely too big, and I'm actually going to show you why it's probably too big. So the next step here is we actually have to assign probabilities to this. So what's the probability of a touch at 362? These two are going to have different probabilities because this is a longer term trade. This is a shorter term trade. We can normalize and use the shorter term window for the comparison. So here we have the 17 Jan 25, the 310 puts, 56 days. But we could say that we're going to manage the trade before it falls within sub 20 days, right? So it means that we're going to manage it sometime within the next 36 days. So that means we can eyeball what is this likely to do over the next 36 days. So we can come in here. We can go to probability analysis. We can say at 36 days, right? So here's our 30-day window at the 22nd, 31, 32, 33, 34, 35, 36, something like this. So we'll look at the 27th and we'll say, what's the probability of a touch at 362 within that 36-day range? Let's go to 362. Like a 85.5% chance. So what I'm highlighting is we know we're trading something that's obscenely volatile. So not only are we looking at too big of a size of a loss, 5K and 21K, but now we can reconcile that the probability of a touch here is like 85% chance. So now we can complete an expected return calculation, or we can remodel the trade. But what I can say is, for my own approach on a directional breakout style strategy, having an 85% chance of a loss modeling a $100,000 portfolio, $5,000 is unacceptable. And I actually would even argue $2,000 is probably unacceptable. It's probably too much. It's that's we're talking about something that's super volatile. So then what can we do here to remodel this? Well, we can take a look either at a different analysis, but we shouldn't go back and overfit our analysis because we don't like this number. That's not the right answer. So what we need to do is figure out how can we decrease the risk here and here for the short put or the long call. So we need to go back and we need to figure it out. So we can say, if instead of going 91 days to the 67 delta, maybe we go further out of the money on the calls. And we say, what would this be worth at 362? All of a sudden, this becomes $3,800. We're starting to move in the correct direction by going further out of the money. It's still a relatively high delta. So then we can add more strikes. And we can say maybe instead of doing a 50 delta, we do a lower 46 delta. Let's see actually any of these that like genuinely look okay. This is a 39 delta with 1672 OI. So this is okay. This loses $3,000. So it still would be a little bit too much. So you might have to include another element to this trade. You can restructure the trade a few different ways. So we can look at doing something like this again. So we have the 440s, which are like a 60 delta, but then maybe we come in here to the 6Ds and we sell the 890s and we create a diagonal, which would look like this. And we can do it off of either of these. We could do it off of this or this. So notice on this trade here, we essentially cut our risk now down to $2,300, but we still have significant upside profit potential. It can go too far. You do have to manage the trade, but this is easy to deal with. This is a way that you can also reduce your risk. I'm giving you guys different ways you can look at this. Then we'll pick one. What I'm showing is the way that we decide whether to buy or sell. As you can tell so far, it's about a series of analysis. It's not about just picking, oh, I want to buy, or, oh, I want to sell. It's not based on that at all. The decision is effectively made for us as we look at these different criteria. That's the idea here. So now, Black says examples are going to reflect at expiration or zero. That's incorrect, because you notice how the example that I'm giving you here has two lines. We have the purple line, which actually represents today. And then we have 7 December, which represents at expiration for the near-term option. So the example here doesn't actually reflect at expiration. It actually reflects today, which is why it's a good example. So back to the analysis though, because we also identified that selling this put was a little bit too much, right? $2,000. Don't really love that. Still too big of a loss. So then what can we do? On the put side, we can decide, and instead of a 20 delta, we could say maybe we do a 15 delta. So we scrub some of those deltas off. So now, on our 15 delta, notice that our risk is only $1,600. So now you're looking at a scenario where you're risking 1.6% of the portfolio, which again, even for me, that's still a little too high, to be completely honest. On a trade like this, that's super volatile. But again, I'm showing you tools to manage the overall risk profile based on what we expect to see. The reason why I don't like risking this much on something like this is because it is literally so volatile. It's an exceedingly high probability that you're going to get stopped out at your target, loss target of 362. 362 is so close to this thing. If we look at the 5-day average range, it's literally 20%. The 20-day is 12.5%. The 90-day is 8.9%. So pretty much in any of those scenarios during standard normal market movement, this is essentially at threat of being hit. Essentially, not quite, but very close. So the overall probability is relatively high. But again, that's also using just a standard distribution. If we look at what we do in technical analysis and look at trend, then yeah, maybe this is okay. Maybe we think that it's going to be a little bit more bullish. Now, the way that I personally would look at this is I actually don't see anything magical about 362. And the way that I would look at this would be if I'm trading this with the intent of getting in now and I want to be wrong fast, I would probably use below the lows of today. And the reason for that is so that I'm not consuming a bigger loss as this thing oscillates. And I would either be right quickly or wrong quickly. And I would rather lean on my technical analysis in the assumption that it's going to go up rather than give it a bunch of room to move around before it may or may not go up. That's the way that I would look at it. So the reason why I voice that is you can already see where my current overall alert is sitting, right? 392.42. This is the first alert that I have set where if it breaks below this, I would want to know. Now, again, I got into this earlier, but I would start scaling out if it's in this zone, of course. And the reason why I would do that is because the overall risk starts to expand because of how volatile it is. So that has to be considered pretty strongly. Otherwise, you can run into some problems with the way that you position the trade. So that's that. Now, if we look at 392.42 and we update this loss point, we add another, for example, of 392.42, 392.42. We know that the probability of this being hit is super high. So right now we're essentially saying, oops, 392 is what I wanted. What we're essentially saying here is I'm either going to be right fast or wrong fast. That's, again, the way that I tend to trade breakouts, especially in something that's highly volatile. If something is not as volatile, I don't mind giving it a little bit of room to move. And again, this is for a very specific strategy of mine, breakouts. If I'm trading something like momentum, giving, again, some context for different ways to set this up. So the way that I trade something like momentum here is maybe it needs to have a little bit more room because I'm expecting it to oscillate as it moves up. And for a momentum style approach, it would essentially follow the series of trade-offs we were just looking at. So if I'm using momentum and I want to cap risk of the portfolio at about 1%, I don't want to lose more than 1% of the portfolio on this one individual trade. So then we need to find a way to lose no more than $1,000. And that's how we have to structure this thing. We can't lose more than $1,000. So one of the easy ways to get there is by selling the 17 Jan 25 260 puts. This also is a really high probability of profit trade. So this gives us a total profit potential of 34.75. You do not get to participate as much to the upside. The reason why I'm giving this to you as an example is because if we, oh no, I forgot, I changed it so that you could see. Is because if you'll remember, based on the profit mechanism analysis, we were originally favoring buying options. That fits our profit mechanism in type much better. But risk has to be assessed. And management of risk is going to overcome what our profit preferences look like, right? This is the part where we look at what I call the ugly side of the trade. We look at the part of the trade that we're not excited about. And we say, this is what I would love to happen. And this is how I would love to set up for this scenario that I think might happen. But it has to be done in the context of risk management. So here, this is essentially what would end up having to go on in a $100,000 portfolio. Now, again, there's other scenarios that could be built out. One of them could be this. Instead of going 90 days out, we could go out less far in time, so we're paying less for the long options. And we can still go further out of the money. We could do like the 990s. They're a 34 delta. And if we look at the 990s at 362, still too much. But at 392, it's more palatable. We're at $1,600 loss at that point. A little bit more tolerable. This is if you expect a big move. And we can look at the expected return here. So now, Tommy, one more question for you. Where do you think in your to the moon analysis, where do you think MSTR might go? And throw that in the chat. In the meantime, I'll show you how I would arrive at a profit target. I would look at something like near-term highs, which in this case is 536. I think it's a little bit higher actually up here. What is it? 543. So let's call it 543 or 550, whatever is fine. And then we go in here and we do the same analysis over the 36 days. And we think it's going to go to 550. There's a 63% chance. So now we have to do a little bit of math. We have a profit target, 550, 63% chance. At that profit target, add this, 550. At that profit target on the long call, we make 4,200 bucks. So LC is 4,200 bucks. Loss target using the 362. $1,600. The probability of touching 362 in that time frame I literally can't even read it. It's so condensed. $86. Like 85.5. This is for the long call. Here's our loss target. Here's your expected return for the strategy, for the long call. And I'm literally building this little calculator so that you can take a look at it for yourself. You can make your own version of this so that you can compare. And now let's take a look at that short put scenario. So here we lose $1,000. And for this, we would again manage within like that 30-day window. And our max profit is $34.75. But again, we're not probably going to get to the max profit because we're going to manage it early. I would just ballpark. We could actually ballpark what it would be so that it's not a guess. The 990, let's take a look at what this is like with like 20 days left for something that's like a 990. Here it's worth oh no, that's on the Call side, duh. On the put side, what did we do? The 260. So here the 260 put is trading for 38.5. Here, 260 is trading for 1935. 20, 38.5, 1935. So these are numbers. And what I'm showing you is a way that you can 39.5, 1935. I think I said, I don't really remember. I'm showing you how you can eyeball what your options would be worth in the time frame. Stop doing the fucking percentages. 2015. So you stand to make 2015. Here. Here's your expected return for this strategy. So now you get to make a fully informed decision based on what you expect to happen. This might seem like a lot of work. The fun part is you don't actually have to do this for every single trade once you get a sense for how this looks. It becomes much more innate. But this is what you're left with. You have a trade where you might lose $1,600, but make 4,200 if it hits your target. You have another trade that will make you $2,000, might lose you $1,000. They both have a high probability of being stopped out. So then it literally is a function of which of these do you prefer. For me, if I'm thinking a big move, this is the clear winner. I'm risking a little bit more money, but I slightly prefer this probability based on the price movement I see. If I need to manage the risk in the portfolio better, this literally cuts essentially 6 basis points off of your total risk. So then you can naturally back yourself into the decision based on the risk side of the equation. What do you guys think? Does the process that we just went through make sense? This doesn't apply to buying options or selling options for directional trades. This literally applies to any trade that you're looking at for quite literally any reason. We're looking at this in the context of buying versus selling options. But this is a way that you systematize the entire process so that there literally is no lingering questions. The entire scenario becomes answered by itself. So to recap what this whole thing looks like is like this. 1, port fit. So this is if we need theta. We have gamma concerns. Because deltas we can manufacture to be whatever we want by buying or selling. That's why delta doesn't matter here. The second thing is the profit mechanism, the type, and the signals that you see that are confirming things. If we're expecting a big move, we might favor buying to start. If we expect a smaller move, we might favor selling in a higher probability trade. Then we need to look at the risk profile. This includes a loss target, probability of hitting your loss target, your risk at your loss target. 4, profit target. Profit at your profit target, probability at your profit target, and then your return at your profit target. 5, is an expected return calculation based on those inputs. 6, decision. If you have a portfolio need, if you need long theta, short theta, that's naturally going to back you into buy or sell. If you have something here, this is going to tilt you one direction or the other towards buy or sell. If you have a specific risk profile requirement, I showed you ways that you can create different risk profiles that may or may not suit your needs. There's going to be an impact on the profit target, but it's important here to start with the risk profile. So if you have a specific risk profile, because here's the other scenario that we didn't discuss here that you have to pay attention to. We're talking about something like MSTR. I told you it's very volatile. What is a reality about MSTR? We set a target of 392 as an exit. What's a very real reality in something like MSTR? Think of it in the lens of a risk profile. What do we think? What would matter to us? Gaps below, a motherfucking gap. So if you're analyzing this and you don't consider the fact that even though we're setting a loss target that can end up being gapped over is a problem, that has to be part of your consideration. And then if one of these two strategies, if you get a gap, if one of these two strategies has a material difference in terms of risk, it's naturally going to select for you. So it can tilt or select for you. This one can select for you. This one leads to a tilt. This one leads to a tilt. This one's a requirement that leads to a tilt. So at the end of this, you might say, don't really care here. This one kind of tilted me towards buying. If I buy options, I have a defined risk on something that might move. I might lose more than I want to lose, but I can still control it within reason. For the profit target, I think something's going to move a lot. I prefer this. They're both positively expectant, but the buy had a greater ER. So that leads me to this. So as I run through this whole thing, it naturally backs me into a buy. So I've not really made a decision until the end. I've just gone through a series of circumstances that then naturally backs me into the decision. So this is the exact process you can use to determine if you want to buy or sell options. Again, this isn't specific to Tommy's scenario for a directional trade necessarily. This is something that you can employ regardless of what you're looking to do. Any last minute questions on this or anything else that you want to hit before we wrap up? My dinner's not going to be here for a little bit, but I got to take care of a little bit of work. But I'm happy to cover anything else that you guys want to hit before I do that. I'm hopeful that the process in general makes sense, that you guys are comfortable with it, and that you have a few ways to go about making the decision. There's no reason for it to be random. Tommy says, mind blown. Yeah, see, this is one of those funny things because for me, that seems like the only logical way to size stuff and to decide choices like that. So it's become so natural to me where it's strange that people would make the decision in some other way. Yeah. Tommy says, can you run through the ER calculation again on a different position? Yeah, I have a video on that for you that you can check out. But all it is the probability of a win times the win size less or divided by the probability of a loss times the loss size. So all we're doing is we're trying to create a probabilistic weighted assessment of the output, right? So we want to not just think about, again, and this is why something like people use, let's say, for example, people say things like keep your wins 2 times the size of your losers. Well, that may or may not make sense because we have to adjust it based on probability. It has to happen. So Dark Mark says, do you know if CEO of Liberty Energy, he's also a board member on OKLO, will have to unload company shares if he becomes head of DOE? That's a fucking great question. I don't know. Let's see if the internet knows. Because government officials, I think, my guess is that they would just have to disclose it. Does the head of Department of Energy have to unwind shares of a company they hold that's publicly traded? It's a good question. I genuinely don't know. Let's see if we can learn. Let's see. Based on the information, the head of DOE, like other federal employees, is subject to conflict of interest rule and may need to divest or rescue themselves from certain matters. Federal conflict interest laws prohibit government employees from participating in matters that could affect their personal financial interests. This includes stocks and other financial holdings in companies related to their agency. So it looks like they're going to have to divest. In the case of Jennifer Granholm, the current Secretary of Energy, there have been instances where she had to address potential conflicts of interests. Granholm faced scrutiny over millions of dollars worth of Proterra. She committed to liquidating these holds as soon as practical, but not later than 180 days. She also sold up to $240,000 in stocks from various companies. So it looks like they get pressured into unwinding. So it looks like it's likely to be unwound. Cryptato, thank you so much for the $50. You know I appreciate it, and you know that the DoorDash driver appreciates it. That one's not going to go all towards the DoorDash driver because I got to pay the thumbnail dude some arrears. So that will also go towards the channel, specifically taking care of the thumbnail dude. So thank you very much. Dark Mark says, your thought on the effect of these companies. I don't know how much he holds. How much is it? Sim says, no, he only has to disclose. I don't think that's true, right? Based on the scenario that we're looking at, Jennifer Granholm, I think the thing that we have to address here is what's compulsory and then kind of what's underlying compulsory, right? So what this is saying is that there's no compulsory forcing function, right? It doesn't say that like they are going to be removed from the position, but my guess is there are underlying soft compulsory things because obviously somebody like Jennifer Granholm, she clearly didn't want to unwind her positions, but she was made to. My guess is if they want to maintain the position without being forcibly removed by somebody, they probably have to dance and play the game. So yeah, I would just be really, really clear that in a practical sense, it's absolutely compulsory based on what we're reading here. In a functional sense, like reading what it looks like, it's not law that they have to. But yeah, do we know, you said the dude's name's Chris, right? Let's see. How much of, what's the company that he holds? Liberty Energy. How much of Liberty Energy does Chris Wright hold? And then I'm hearing a little bit of scritchy scratching at the door. You know what that means. So this is I think a post dinner nug. He looks fed. He looks content, as you could tell. You can't really see his eyes. He has like the black on black, unless you look at his chest. His chest has a lot of white, but he's on the black on black. Some of his feet also have a little bit of white, as you can tell. Something like that. So he's here ready to do a little bit of homework, as you could tell. He's settled in. He's going to go hang out with the in-laws. So let's take a look. There's no specific information about how much he holds. It seems like that would be very public. I don't know why that wouldn't be public. To obtain accurate information about his stake in energy, they would need to consult the company's latest SEC filings. Okay, so find the SEC filings. Find the SEC filings for me to check. The fuck? Who the fuck do you think this is? Dr. Zaya says he looks ready for bed. That's actually it's a complete decoy, because we go for a walk after dinner. And he comes in here literally to try to pressure me. I haven't had dinner yet. I'm going to eat in a minute. But yeah, during the walk, he is a absolute crackhead. Yeah, so here we go. This looks like he found it. However, I can guide you to visit SEC, search for Liberty, look for Form 4 for more comprehensive view of insider transactions, review multiple Form 4 filings over the year to corroborate the reported 438,000 shares held by Christopher Wright. Literally tells me right there. I don't know why I couldn't have told me that. So it looks like he has 438,000 shares. What's that as the float? I guess I could just ask this. What is 438 of the total float? Uh, 0.27? Is that right? That seems like completely trivial. LBRT. This is reporting 158 million. This is 163. Yeah. So, and then what's the volume? No, I mean, it'll definitely move the float, or it'll definitely move the price, but I mean, I don't think it's going to move it much. Tim says that will not move the market. I think it will. I just don't think it will much. The reason why I think it will is I'm just looking at the average daily volume, right? So we see 3 million, 1 million, 2 million. If we go back further, it's as low as 896,000, so 900,000. So with that low of a daily volume, it's, again, I think the impact to the broader point wouldn't be like severe or long-term felt, but I definitely think in the course of a day, or however what the divestiture period would be, that with the persistent unwind, it probably would be felt a little bit. I think so. So, yeah. Sim says they will not sell it all in one day. They won't, but they're going to try to sell it quickly, because one of the problems that they're going to face is if the market knows that an entity is starting to sell and they can pick it up, which again, with volume as light as this, you typically can, it'll be people trying to bid it up, right? And just get them fucked for better prices. So yeah, I think there's a good possibility. Cool. All right, gang. Well, I think that's all I got. So we'll keep on with the beginner sessions on Friday. Quick update. I don't know about live streams essentially for the next week. I'm planning on doing the GME live stream tomorrow, but it is TBD just because we're doing a little bit of traveling. So we'll see. I'll keep you guys up to date with it as it gets closer. So as you guys know, if you need anything, hit me up in the Discord. For those that are in the mentoring program, please book your calls for December, because I also have a bunch of travel coming up in December and I don't want you guys to get crunched up, because I'm sure a lot of people have stuff on their schedules. So please use the Calendly link, grab some time so that we can connect and get us moving forward before the holidays hit too hard. All right, all, be an outlier. I'll see you later.